All right, I just want to go through one or two things in the solution to the cash flow question you were doing. I'm not going to do out the full solution. I'm just going to read through the solution and pick up on one or two things which quite a few people got wrong. Okay, so most people got most stuff right, so I don't want to kind of spend time doing out the full thing. All right, so there's my question. Starting in the solution here, most people had most stuff right in the abridged profit and loss. Just the interest payable of 22,000. Debentures last year were 250, debentures this year are 300, so I just need to know when that increase happened. I'm told it happened on the 30th of June this year. So when I'm doing the 8% interest, it's 6 months at 250 grand and at 6 months at 300 grand. They have that calculation included as part of the solution. The tax payable here then of 43, just taxation due on the 31st of December 17 was paid during the year. So this tax of 38,600 owing at the end of last year was paid this year. So that means all of this 43 owing at the end of this year is for this year. So if it's tax for this year, if it's tax for 2018, it should go on the 2018 profit and loss, and that's what I'm trying to recreate here. Okay, interest receivables come up in the question, but kind of most people were all right on this section here. Down to the reconciliation, again, most people got the kind of common ones correct here. Just the amortization of goodwill of 7,000. So amortization of goodwill, we see it here in the balance sheet. Goodwill is going from 70 to 63, so it is decreasing. So that intangible asset is decreasing. And I'm told down here goodwill is being amortized over a 10-year period. Amortization is just like depreciation, so it is it's a non-cash expense. So it will be subtracted in coming to your profit. We want to undo that. So we add the 7,000 back because we're trying to get closer to like a cash profit figure here. So I'm undoing this 7,000 non-cash expense by adding it back. So it's just the exact same treatment as depreciation, which people got. The stock, the creditors, people got fine. Just the debtors and the bad debt provision here. Just there's, I suppose, two different ways you can treat it. So debtors was 38,400 last year, 33,600 this year. Difference between those two numbers is 4,800 decrease in debtors. So you can add that on in this section of the solution. So decrease in debtors 4,800, and that will be correct. Okay, just the solution has a slightly different treatment. Okay, it does the debtors and the bad debt provision separately. So I'll just run through that treatment, but again, just adding back the 4,800 would be correct. All right, so what they are doing is, if you note, the debtors is after a 4% provision. So these two debtors amounts are after a 4% bad debt provision has been taken away. So they're like 96% of the debtors figures. So if they're 96%, let's work back to 100% by dividing by 96 and multiplying by 100. So this year's would be 35 before that provision, and last year's would be 40,000 before the provision. So what's the difference between those two amounts? It's 5,000. All right, so decrease in debtors, 5,000, and that's what you see in the solution. All right. However, if you do it that way, you do then need to treat the debtors, the provision separately. Okay, so what's the 4% provision? It'd be 1,400 this year, 1,600 last year. So that is a decrease in bad debt provision. Decrease in provision, good thing. It will be other income in your profit and loss. But remember, you're trying to undo that. So to undo the decrease in bad debt provision, you would subtract it. So that would have been €200 added on in the profit and loss. We're undoing it by subtracting €200. And there we see add on 5,000, take away 200. It has the same effect as just adding on the 4,800 by just tracking the change in the debtors figures that they give us in the balance sheet. So it will be fine to just use the 4,800. All right, so either treatment is fine there. So 5,000 minus 200 kind of separately, or just add back the 4,800. The main thing people slipped up on this is the profit on the sale of fixed assets. So a few people just kind of said, plant machinery cost 60 was sold for 46. So cost 60 sold for 46. That is a loss of 14. Okay, but you don't compare the cost to the selling price. You compare its value. Okay, its net book value, what it was worth when you sold it. So you need to figure out what depreciation would there have been on that plant and machinery. All right, there is a little bit of working out here. So I'm told that the total depreciation charge for the year is 19,000. Okay, there's no other disposals here, so this is the only one I need to worry about. So depreciation for the year is 19,000. Let's go up and look at accumulated depreciation. I can see that accumulated depreciation on land and buildings goes up by 9. But on plant machinery, it goes down by 14. So that's not a 19,000 euro depreciation charge. It's going up by 9 and down by 14. So there's something else going on there. And what that would be is when you sell an asset, any accumulated depreciation, you clear out of the accounts. So that's how I'm going to get at that figure. So 19,000 depreciation is what I'm told was put through the profit and loss. So there's no disposals of land and buildings. So land and buildings accumulated depreciation is going from 18 to 27. So that is an increase of 9. So of my 19,000 depreciation charge, 9,000 of it is here, going from 18 to 27 on land and buildings. So that means 10,000 of my depreciation charge must be for plant and machinery. So if there was 10,000 depreciation on plant and machinery, accumulated depreciation would go from 68 to 78 here. But it's not 78 here, it's 54. Why is it 54? Well, it's because when I sold that asset, all the accumulated depreciation was cleared out. So the difference between the 78,000 accumulated depreciation I'm expecting and the 54,000 that's there, that's the depreciation that was cleared out of the accounts when I disposed of that asset. So 24,000 must be the depreciation on that asset when I sold it. So take that 24,000 away from the 60,000 cost, and it has a book value of 36 when you sold it. You sold it for 46,000, so you sold it for more than it was worth. So you're making a profit of 10,000. That profit would have been other income in your accounts, so you're undoing it here, so you subtract the 10,000. All right, on to the cash flow statement then. People brought this figure down right. Interest received is fine. Interest paid is just the 22 you had, making the adjustments for what was due at the start and end of the year. Tax paid is just what was due at the end of last year. Into this section here, we made a few little mistakes. So receipts from sale of fixed assets need to go in here. This one is just given to you in the question. So plant and machinery, which cost 60, was sold for 46. So that 46 there is my receipt on sale of fixed asset. All right, so that's what goes in there, the actual receipt. So we're looking for cash amounts here. All right, we're not looking for like the profit on sale of fixed assets. Profit on sale of fixed assets is kind of a an accounting construct a little bit because we're including depreciation. I'm just looking for what money did I receive. I received 46 grand. The payments to acquire fixed assets then 214. There's a little bit of working out to these. So let's just start with what were the fixed assets last year. So December 17, 400 grand land and buildings, 286 plant machinery. So 400, 286. By 2018, then they are 510 and 355. So if it was a really simple question, I would subtract those from each other and that would be my additions, but there's just a little bit more going on here. So let's say plant and machinery 286. Now, I've already been told in the question that I sold an asset there worth 60 grand. So I would expect my 286 last year to go down by 60,000 because I know I sold something. So 60,000 would be subtracted from that when you sold it. Okay, so that means 286 minus the 60 I sold. I would expect plant and machinery to be 226. It's actually 355 in the accounts, so the difference between those must be additions. And they're 129. The land and buildings then, 400 last year. There's no disposals here of land and buildings, but, and this is a kind of tricky one to spot, there is a revaluation reserve of 25 grand. So I didn't have a reval reserve last year, I do this year, and I'm told that the revaluation that took place was an increase in the value of land. So last year's 400 grand, I would expect that to go up to 425 because I've revalued the land and I obviously increased its value by 25 if that's what went into the revaluation reserve. So I would expect land and buildings to be 25,000 higher. So what I might expect this year is 425. But what are the actual assets? 510 according to the accounts. So 510, take away the 425 is 85,000. If you add the 85 and the 129, that's your 214,000 payments to acquire fixed assets. All right. So I think about it like that. So kind of look at any disposals and additions that you know, any disposals and revaluations that you know about. So what effect would you expect those to have? Then what are the actual numbers, and the difference between those will be the additions you made. So 214,000 in this case. Just going back to the solution then. Next thing in here, yeah, so receipts from sale of investments should go in here. So this isn't when we maybe saw too much in questions, but you see investments here went from 45,000 last year to 30,000 last year. So I must have, my investments have decreased. I must have sold some of my investments. So that's 15,000 cash coming into me. So that's an increase, that's a receipt. So that 15,000 needs to go into this section here, capital expenditure and financial investment. Dividends paid, people did all right. This is just a subtotal. People were fine there. Purchase of government securities, yeah. So your government securities went from 10 to 15. So you must have paid 5,000 to acquire new securities. So remember, you're looking at the cash side of the transaction here. So you spent 5,000 to acquire those assets. Financing was fine. So debentures went up by 50, ordinary shares went up by 50, share premium went up by 20. That's all coming from the balance sheet. The revaluation reserve doesn't go in there. So revaluation reserve is kind of an accounting concept. It's to recognize the increase in value of your asset, but it doesn't mean you're kind of receiving 25,000 euro. So it shouldn't go in here. So the cash flow statement is just movements of cash in or out. So it's just those three items there. And you end up with an increase of cash of 18,130. Just one thing to say then on the purchase of government securities. So up here in the cash flow statement, I'm looking at it as I have to pay 5 grand to acquire those. Down here in the reconciliation of net cash flow to move with the net debt, I'm looking at the fact I have 5,000 more of liquid resources, something I could turn into cash pretty quick. So it's a negative up here, it's a positive down here. The kind of other side of that then is the issue of debentures. So up here, I look at the fact that if I kind of take out another 50 grand of a loan, that's 50 grand of money coming into me. So it's a positive up here. But down here, I look at the flip side of that, I have to pay that back. So it's another 50 grand of debt. So that's why it's negative down here. So those two items, the 5 and the 50, go in down here as well. And then just the net debt figures at the start and end of the year, they break it down here in the solution where they're coming from. So a couple of people kind of had stuff left out of those. So just look at where they're getting those numbers from. Okay, but as I said, most people had most stuff correct. I'm just kind of highlighting there a few tricky bits which tripped people up.